Ladies and gentlemen, OG John AG here, and I need you to sit with this for a second because what I'm about to show you is not hype, not speculation. It is verified market reality as of January 25th, 2026. Gold's total market capitalization just crossed $34.6 trillion. Let me say that again, 34.6 trillion at nearly 4,190 per ounce. Silver sitting right there around $13 per ounce with a market cap of 5.8 trillion. Now compare that to what the mainstream has been shoving down your throat for the last 3 years. Nvidia, the darling of artificial intelligence, the chip that was supposed to rule the world, 4.57 trillion. Bitcoin, the revolution that was going to replace gold, 1.77 trillion at 88,800 per coin. Quick heads up, link in description for the WhatsApp community, real-time vault flows, premium alerts, macro updates, and what I'm building next for serious stackers only. Now let me connect the dots for you because this is not just a price milestone. This is a market capitalization statement. This is global capital telling you exactly where it is flowing when uncertainty becomes the only certainty. Gold has gained over 80%. Silver has tripled, not in some fantasy chart, not in a back-tested model, but in actual purchasing power, actual weight you can hold in your hand. And the mainstream media, radio silence. Because acknowledging this destroys the narrative they have been paid to sell you. That tech is the future. That digital tokens are the new gold. That fiat liquidity can paper over every crack in the global monetary system. Let me ask you a simple question. If gold is a barbarous relic, if silver is just an industrial metal with no monetary premium, why is combined precious metals market cap now over $40 trillion? Why are central banks around the world accelerating purchases at record levels not seen in decades? Why is China quietly hoarding every ounce of physical it can pull from London and New York vaults while simultaneously restricting exports of antimony, gallium, germanium, and now discussing potential silver export controls? Connect the dots. This is not about tradition. This is about survival. The narrative you have been sold goes like this. Bitcoin has a fixed supply of 21 million coins, so it is digital gold. Tech stocks represent innovation and future productivity. So they deserve infinite multiples. Precious metals are dead money. Boomer rocks, relics of a bygone era. But here's what they do not tell you. Bitcoin's fixed supply means nothing if regulatory frameworks collapse confidence or if energy grids fail to sustain mining operations. Nvidia's 4.5 trillion valuation is built on projected earnings that assume stable geopolitics, continued access to Taiwan's semiconductor fabs, no disruption to rare earth supply chains, and infinite appetite for AI infrastructure spending. Now look at gold, look at silver, no counterparty risk, no dependence on electrical grids, no software updates, no central authority that can change the protocol, just elemental reality. 79 protons for gold, 47 for silver, unchanged for 4 billion years, unchanged for the next 4 billion. You want to talk about fixed supply? Global gold reserves grow at roughly 1 to 2% per year from new mine output. Silver. We are in a structural deficit. Industrial demand from solar photovoltaics, electric vehicles, 5G infrastructure, military applications, and AI data centers is consuming more silver annually than mines can produce. And the above-ground stockpiles that buffered the market for decades depleted. Let me take you inside the mechanics because this is where it gets really interesting. The $5.8 trillion market cap for silver at $13 per ounce tells you something critical. It tells you that despite the liquidity challenges, despite the fact that you might take a 10 to 20% haircut selling physical silver in size compared to spot price, despite the storage costs, despite every friction point the system can throw at you, capital is still flooding in. Why? Because the people moving that capital understand what is coming. They understand that paper markets and physical markets are diverging. They understand that COMEX registered inventories, the actual deliverable silver backing futures contracts have been drained to levels that would have triggered a default crisis in any normal commodity market. Here is the data you need to verify yourself. Go look at COMEX silver warehouse stocks over the past 18 months. Registered silver, the portion available for delivery, has been oscillating at historical lows while open interest remains elevated. That is a squeeze waiting for a catalyst. Now cross-reference that with Shanghai Gold Exchange premiums. When physical gold in Shanghai trades at a premium to London, it signals that Eastern buyers are willing to pay more for metal they can touch than Western paper prices reflect. That premium has been persistent. It is telling you that the arbitrage, the mechanism that is supposed to equalize prices globally, is breaking down because there is not enough physical metal to move. Let me hit you with the geopolitical angle because this is not happening in a vacuum. The United States is reshoring manufacturing, slapping tariffs on Chinese goods, trying to rebuild domestic supply chains for everything from semiconductors to solar panels to defense systems. Every single one of those industries is silver intensive. Europe is accelerating its energy transition mandates despite the economic pain, which means more solar, more wind, more battery storage, more silver. China is the world's largest silver consumer and a major producer, and they are not exporting the way they used to. They are stockpiling. They are preparing for a world where access to critical materials is a weapon, not a given. BRICS nations are openly discussing trade settlement in currencies other than the US dollar, backed by commodity baskets that include gold and silver. Russia has been accumulating gold for over a decade, insulating itself from Western sanctions. Saudi Arabia is taking Chinese yuan for oil and converting portions into physical metal. India, the world's second-largest gold consumer, just saw record import volumes despite high domestic prices. These are not speculative traders. These are nation-states, central banks, and sovereign wealth funds moving generational capital into hard assets, because they see the same cracks in the global financial architecture that you should be seeing. Now, let us talk about the elephant in the room. The 20 to 25% bearish case that I will always give you because I am not here to pump, I am here to prepare you. The resistance factors are real. Liquidity in physical silver is not like liquidity in equities. If you need to liquidate a significant stack quickly, you're taking a haircut. 10%, 15%, sometimes 20%, depending on the dealer, the premium environment, and how desperate you are to sell. That is a real cost. Storage is a real cost. Insurance is a real cost. For large holders, vault fees, security, logistics, these add up. Compare that to clicking a button and selling shares of an ETF, and you see why retail investors hesitate. Number 2, central banks can intervene not by dumping gold. They have been net buyers for 15 consecutive years, but by manipulating narratives, by coordinating with bullion banks to suppress paper prices through futures market positioning. We have seen it before. The commitment of traders reports have shown concentrated short positions by a handful of commercial banks that defy any rational hedging strategy. JP Morgan paid a $920 million fine in 2020 for spoofing precious metals markets. That is not conspiracy. That is settled legal fact. So yes, they can delay. They can create volatility. They can shake out weak hands. Number 3, if deflationary forces overwhelm the system, if we get a sudden liquidity crisis where everything gets sold to cover margin calls, gold and silver can get hit in the initial panic. We saw this in March 2020. Gold dropped from over 1,700 to below 1,500 in 2 weeks before rocketing higher. Silver got obliterated, falling from $18 to $12 in a matter of days. It does not mean the thesis is wrong. It means that in a deleveraging event, even the best assets get sold because they are the most liquid. You need to be prepared for that volatility psychologically and financially. You need dry powder to buy those dips if you believe in the long-term trajectory, but here is what those bearish factors do not change. The structural deficit in silver is not going away. The industrial demand curve is not flattening. It is steepening. Solar panel installations are projected to double again by 2028. Electric vehicle production is ramping globally, and each EV uses anywhere from 25 to 80 grams of silver, depending on the model. 5G infrastructure build-outs require silver in every base station, every antenna, every circuit board. Military and defense applications are consuming silver at record rates for missile guidance systems, radar, avionics, and next-generation weapons platforms. None of that demand is discretionary. None of it can be easily substituted. Silver's unique electrical and thermal conductivity properties make it irreplaceable in high-performance applications. And here is the kicker. Even with silver at 103 per ounce, even with that 5.88 trillion market cap, it is still undervalued relative to gold on a historical basis. The gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, is sitting around 48.1 right now. Go back and study the ratio over the past century. The long-term average is closer to 55 to 60 to 1, but there have been periods where it compressed to 15.1, 30 to 1. If silver were to revert to even a 40.1 ratio with gold at $5,000, you are looking at $125 silver. If it compresses to 30 to 1 in a true monetary crisis scenario, you are talking $166. And I'm not making a prediction here. I'm showing you the mathematical possibilities based on historical precedent. Now, the mid-video, reframe, the angle that changes how you should be thinking about everything I just told you, that $34.6 trillion gold market cap and 5.8 trillion silver market cap. Those numbers represent the current valuation of all the gold and silver that has ever been mined and is still in existence above ground. Think about what that means. Every ounce of gold ever pulled from the earth throughout human history, from the Egyptian pharaohs to the California gold rush to modern industrial mining, is now collectively valued at 34.6 trillion. That is not the value of new production. That is the global stock, the total inventory that civilization has accumulated. And despite decades of mining, despite all the technology, despite all the capital deployed, that stock only grows at 1 to 2% per year. Compare that to fiat currency. The US M2 money supply has grown from under $4 trillion in 1990 to over 21 trillion today. That is more than 5x in 35 years. The Federal Reserve's balance sheet went from under 1 trillion before the 2008 financial crisis to nearly 9 trillion at its peak. That is dilution. That is debasement. And every single dollar, euro, yen, or yuan that gets created out of thin air is a claim on the same finite pool of real goods, real energy, real resources. Gold and silver are not going up in value. Fiat currencies are going down in purchasing power. And the market cap numbers you are seeing now are the market screaming that truth at volumes that cannot be ignored anymore. So what does this mean for you? For the person watching this, who is trying to navigate the most uncertain macro environment in generations, it means you need to stop thinking about gold and silver as investments and start thinking about them as insurance and optionality. Insurance against monetary debasement, against currency crises, against the breakdown of the Bretton Woods petrodollar system that has been fraying since Nixon closed the gold window in 1971. Optionality, because if the physical market truly decouples from the paper market, if COMEX or LBMA face a delivery default, if China announces strategic silver export restrictions, the upside is not linear, it is exponential. But you also need to be smart. Do not chase price. Do not FOMO into overpriced numismatics or sketchy dealers offering deals that are too good to be true. Do your due diligence. Compare premiums across multiple reputable dealers. Understand the difference between government-minted bullion and generic rounds. Know your exit strategy before you enter. Allocate a portion of your portfolio that you can afford to hold through volatility, through drawdowns, through periods where the mainstream tells you that you are an idiot for not being Allen on tech stocks or crypto. And understand the technical picture, because it matters. Gold at $5,000 is testing psychological resistance, but the momentum indicators are showing strength, not exhaustion. RSI is elevated, but not in overbought extreme territory. Moving averages are aligned bullishly across multiple timeframes. Volume has been confirming the price action, which tells you this is not a low liquidity melt-up. This is broad participation. Silver at 103 has broken through decades of resistance and is now consolidating above key Fibonacci extension levels from the 2020 to 2023 base. If it holds above 100 on any significant pullback, that becomes your new floor, your new support zone to add. One historical parallel I will give you, and I qualify this heavily because history does not repeat, it rhymes. In 1979 to 1980, silver went from $6 to $50 in a matter of months. During the Hunt brothers accumulation and broader inflation panic, gold went from $200 to $850. The circumstances were different. The Hunts were trying to corner the market. The Fed under Volcker jacked interest rates to 20% to kill inflation. The subsequent collapse was brutal. Silver fell back under $5 within 2 years. But here is the difference. The fundamentals today are not driven by two billionaires trying to squeeze a market. They are driven by structural supply deficits, industrial demand that cannot be shut off without collapsing the global energy transition and technology infrastructure and geopolitical fragmentation that is weaponizing commodity flows. The second brief parallel. In 2011, gold hit $1,900 and silver hit $49 before a multi-year bear market that took gold back to $10.50 and silver to $14. What caused the collapse? The European debt crisis was contained. QE infinity from central banks stabilized markets. Risk appetite returned and capital rotated back into equities. Could that happen again? Absolutely. If central banks somehow engineer a soft landing, if inflation comes down without recession, if geopolitical tensions ease, capital will rotate. But ask yourself, do you see any evidence that those conditions are forming? Because I do not. I see debt levels that are higher, deficits that are wider, geopolitical tensions that are hotter, and central banks that are trapped between inflation and insolvency. 3 key takeaways from today. Number 1, gold's 34.6 trillion and silver's 5.88 trillion market caps are not speculative bubbles. They are the market's valuation of the only assets with zero counterparty risk in a world drowning in counterparty risk. Number 2, the liquidity and friction costs of physical metals are real, but they are the price of holding an asset that cannot be debased, hacked, or confiscated by executive order as easily as digital entries in a bank ledger. Number 3, the divergence between paper prices and physical availability is widening, and when that gap becomes unsustainable, the snapback will not give you time to react. The unresolved tension I'm leaving you with is this. Bitcoin supporters are right about one thing. Capital does rotate. When gold peaks, historically, some of that capital has flowed into risk assets, into equities, into alternatives. Bitcoin's 21 million fixed supply and decentralized structure make it a legitimate contender in that rotation. But the bet you are making is that the infrastructure, the regulatory environment, and the societal trust in digital systems will remain intact through the chaos ahead. Precious metals do not require that bet. They have survived every empire, every currency collapse, every technological revolution for 5,000 years. So do your research, verify every claim I have made, cross-check the sources, look at the data yourself, and make your decisions based on logic, not hype, not fear, not greed. This is your capital. This is your future. Treat it with the seriousness it deserves. Invest with logic, not hype.